Welcome to the Divorce the IRS Podcast, the retirement income planning podcast designed specifically for those who want to pay the least amount of taxes possible and build a retirement income that lasts. Inspired by the best-selling book, Divorce the IRS, you get to go behind the scenes with financial planner, author, and speaker Jimmy Miller. Learn how to set yourself up to pay the least amount of taxes in retirement when you'll need your money the most. And now, here's your host, Jimmy Miller.
Welcome to the Divorce the IRS Podcast. Today, we explore why the advice often given by tax professionals, and some advisors as well, may not be in your best interest in the long run. Let's jump right in. Now, I don't have anything against tax preparers, and I have good friends who are in the tax industry. One of the best tax professionals I know, Nick at Revolve Tax, actually wrote the foreword for my book, Divorce the IRS. Tax professionals are a necessity in our world where everything seems to have become so complex that you need a specialist to help, especially with taxes. But I urge you to understand how most tax preparers think and why this thought process is usually not in your best interest. Many tax professionals are not even aware of the harm they're causing. It's just that they have never been taught to think about taxes holistically. Some tax preparers are also tax planners, but this is rare. It's a small distinction, but one that can make a big difference. It's usually best to work with a fiduciary financial advisor who is also a tax planner and preferably a tax-free planning specialist on tax planning issues, and then take that advice to your tax preparer for them to execute. Let's discuss why. The tax preparation industry seems to have one goal each and every year: to help you receive the largest refund legally possible on your tax return. Notice I did not say their goal is to help you pay the least amount of taxes. Your tax preparer may also make this claim, but the question is one of time frames. They rarely consider that the largest refund this year might not be in your overall best interests and may lead you to paying more taxes over the course of your lifetime. It's like going to a restaurant that believes you're only there to eat the most food possible. They will promise to help you get the absolute most amount of food into your stomach, regardless of the health consequences to you in the long run. Tax professionals tend to think in terms of the biggest refund in the current tax year and nothing else. They understand most people feel the happiest when they receive the largest possible amount of money back from their tax return, or at least pay the least amount to the IRS if they owe. Tax preparation is a business, and it's good business to make your customers happy, right? How else would they expect to get referrals and repeat business? Here's a secret, though. Getting the most back from your tax return each year may not be in your best interest when considering your lifetime tax plan and how much you will pay the IRS over the balance of your life. Most tax preparers consider a single tax year and not your lifetime tax plan. Would you take a loan from me today if I said you had to pay it back quadruple later? That is, with 400% interest? Maybe you would. But in most cases, I think you'd agree it probably wouldn't be in your best interest to pay so much interest. Yet that's exactly what so many people do when they maximize their retirement plan deductions for the current year. They are not really saving any money on their taxes. They are just kicking the tax issue or payments down the road with a compounding effect they don't think about. Many Americans will happily push off this or any problem until later, not realizing that putting it off isn't like kicking a can down the road. It's more like pushing a wet snowball down a snowy slope. Americans want the most they can get right now. I call it the instant gratification issue, which we'll talk about in a minute. But first, let's take a look at an example. If you save $100 in a tax-deferred account and you're in the 20% tax bracket, to make math easy here, you get a $100 tax deduction from your taxable pay, and that puts an extra $20 in your paycheck. And that's great, you think, but the problem is that you didn't really save the full $100. You saved $80, and the IRS gave you a loan for that $20 that you'll have to pay back to them one day. The IRS now has a lien on your $100, and they're gonna tax that money, just not till later, after it's grown, and they can take even more taxes from you. You see, if your $100 grows over your working lifetime to, say, $400, and you're still in that 20% tax bracket when you want to take the money out, you will owe tax on the whole $400, or $80 worth of taxes. Do you really want to have an extra $20 in your paycheck now so that you can pay the IRS back $80 in taxes on that $20 loan they gave you way back when? I bet you don't if you really think about it. Even if your tax bracket in retirement is only half of what it is today, which it probably won't be, but even if it is, and you're in the 10% tax bracket when you need to take your money out of your pre-tax account, you're still going to owe $40 in this example on that money in taxes, double the amount you got as a loan when you put that money into the account. This isn't a good deal for you, but it sure is for the IRS, which has more patience than most Americans I know, which brings us back to the instant gratification issue. This problem of instant gratification in America isn't new. It is pervasive throughout our culture and only appears to be getting worse. It rears its ugly head everywhere and can be damaging when left unchecked. From the overuse of credit cards, to sign and drive programs, to needing your Amazon delivery within 2 hours, this mindset is financially devastating, especially when it comes to your taxes. The most financial damage from instant gratification craze happens when Americans want a little more from their tax return and are willing to sacrifice their future income substantially to have it now, as you will see in the upcoming examples. It's even worse when they take a tax refund loan from their tax preparer with a high interest rate and a service fee built right into it. For example, when someone could receive $2,000 refund in 2 or 3 weeks from the IRS, but they gladly accept $1,500 as a refund loan today instead of waiting. It's if people must have everything right now. Unfortunately, advice based on instant gratification bleeds into the financial industry as well. Too many financial advisors are happy to tell you to contribute to an IRA and save on your taxes this year. This is the easiest and laziest advice to give, and it's often bad advice. Most do so without ever putting any thought into the future tax rates you may be subject to, or the future tax time bombs this advice may be lighting the fuse on. They do so as a blanket recommendation without any comprehensive tax or financial plan in place for you. Now, I want to be clear. There are definitely times within financial planning where it makes sense to put your money into tax-deferred accounts and take the tax savings now. For example, I sometimes have people reach out to me who want to retire in the next couple of years, yet they haven't saved much towards that goal. They're now in the highest earning years of their life, and they're ready to get serious about saving and investing. In this situation, it clearly makes sense to use tax-deferred accounts, as this person will not have much saved by the time they retire, and the tax deductions now, at those high tax brackets, will save them money right now that they can also save for the future. When they retire in just a couple of years, not only will their nest egg not be that big because they only saved for a couple of years, it won't have had time to really grow and compound on its own over that short period of time either. So in this case, taking the tax deductions now probably makes sense. Here's a very important point. If your financial advisor hasn't discussed taxes as part of your financial and/or investment plan or asked to see your latest tax return, this is a sign you should seek a new advisor. A true financial plan or planner cannot exist without considering your current and lifetime tax situation. Many financial salespeople are also eager to sell tax-deferred investment products like annuities. These products often pay salespeople very large upfront commissions and come with long surrender periods, which is a period of time when you cannot get your money back without penalties. They are products that, when structured incorrectly, can compound your tax problems later in life and tie you to the IRS for life as well. The salespeople pushing these products usually convince you that you can keep more money from the IRS if you just buy tax-deferred products and don't run the risk of pushing yourself into a higher tax bracket. Not all financial salespeople are bad, and neither are all annuities. I just want you to be careful when considering both. However, it's not just the non-fiduciary financial salesperson that's gaming the American public. The system created by the IRS is an even more elaborate tax maze full of trickery and misconceptions. Many tax regulations are designed to put more money in the coffers of the IRS at your expense. You will understand how they do this after listening to the next few episodes of this podcast. But before we get into how to beat the IRS at its own game, let's discuss the biggest myth and argument surrounding tax-deferred investing. Being in a lower tax bracket during retirement means tax-deferred investments are good. In the next episode, we're going to blow this myth wide open with examples of why you probably won't be in a lower tax bracket when you reach retirement age, especially if you're a saver. Don't forget to subscribe to the podcast so you don't miss the next or any of the upcoming shows. See you there.
Want even more ideas, tools, and resources on how to navigate your financial life? Check out all the resources on the Divorce the IRS website at divorce-the-irs.com or the Baobab Wealth website at baobabwealth.com, and subscribe to the blog to stay up to date on issues affecting retirement income planning. Don't forget to subscribe to the podcast so you never miss an episode. Baobab Wealth and Baobab Wealth Abroad are DBAs of Baobab Wealth LLC, a Florida registered investment advisor. This podcast is designed for general education purposes only and shouldn't be taken as legal, investment, or tax advice. You should seek out a qualified tax professional or licensed financial advisor to determine what is best for your personal situation.